Good day, everyone, and welcome to our confidential report for December. Of course, it's the last confidential report for the year, and next year we will have another confidential report on Wednesday, the 1st of February. So make a note of that in your calendar. All right, let's begin as we always do in America. The Democrats have surprised us in the midterms, and I think that this signals the demise of Donald Trump's Make America Great Again movement. There's been an irreversible reduction in his influence over the Republican Party. And now, of course, he's got a pattern of electoral defeats, which was, of course, confirmed this morning by the loss of Walker in Georgia. It's another Trump appointee, and he's being painted as a loser, and that arguably is the worst possible outcome for a budding fascist like Donald Trump. As a budding fascist, you can be accused of sexual perversion, you can be accused of being a liar, you can be accused of being fraudulent. But the one thing you must never be accused of course, is being a loser, and that is what is happening to him. He's being painted as a loser. And of course, he's facing huge legal battles which are looming, and his idea of running for president in 2024, although announced, in my view, is already in tatters. Of course, he will always have some bitter ender supporters, but I think he is basically a spent force in US politics. But we'll see. Time will tell. The Monetary Policy Committee in America has raised interest rates by 75 basis points 4 times since they started, and by a total of 4% so far. Jerome Powell has said that they will moderate the pace of increases as early as December this year. So it looks like they'll have another 0.5% rise in December, and probably some 25 basis point raises after that. His speech was construed as being dovish, and the bulls pushed the S&P 500 up 3% in a single day, on the day that he did the speech. They seem to have lost sight of the fact that Powell is completely determined to bring inflation down to 2% in America, from its current level around 7.7%. They are also ignoring the cumulative impact of rising interest rates. Every month that goes by, the effect of previous interest rates has a greater and greater impact. And the cumulative impact of rising interest rates is often forgotten by investors, but it does affect the economy. It must impact on consumers and on businesses fairly soon. Of course, nobody knows quite how high interest rates will go, or how long they will stay there once they're up there. But I think Powell is looking for some clear evidence that rates are impacting on spending. There must be evidence that unemployment, for example, is increasing in America from its current record levels. Of course, the higher rates are beginning to impact on the economy, especially in the property sector. Pending home sales were down 4.6% in October, and that's the 5th consecutive month that they've fallen. There has, of course, been a reduction in the consensus estimates of S&P 500 companies' profits. But GDP in the third quarter was up 2.9%, which is a massive increase for an economy the size of America. The economy created 263,000 new jobs, and the economists were only expecting 200,000. So that was also bullish. It shows that the American economy is still growing. Excuse me. At the moment, there are now 1.7 new jobs available for every available applicant. So there's obviously some wage pressure. Wages are being pushed up. Clearly, the economy is still thriving despite the rising interest rates. It's nowhere near the point at which rates begin to impact directly on inflation, in our view. The drop in inflation from 9.1% in June to 7.7% in October is an improvement, but it still has a long way to go. and it may yet go up again before it goes down. Powell said it is possible for the US economy to have a softish landing. That's what he called it. We believe that that economy is headed into recession next year. The only question really remaining at this point is how bad the recession will be. Our reason for regarding a recession as inevitable is the yield inversion, and it's a record yield inversion. Normally, long-dated bonds like the US 10-year Treasury bill command a higher interest rate than short-dated bonds like the 2-year US Treasury bill, because investors are obviously required to tie their money up for a longer period, and so they demand a higher interest rate. And normally the 10-year yield is higher than the 2-year yield. But last week, the yield on the 2-year was 4.481%, while the 10-year yield was at 3.752%. So that is a record 73 basis point yield inversion. It's one of the highest yield inversions in decades. And it's a sure sign that investors are expecting a recession soon. Look at the chart on your screen of the S&P 500. This is a chart you should by now be familiar with. It shows the record high here on the 3rd of January this year at an index level of 4796, and then you can see how we have established now a downward trend line. We've had 3 rallies. This is the first rally, that's the second one there, and this is the third rally. And of course we've been making successively lower lows and successively lower highs. What is particularly interesting about this chart is that last week the S&P 500 came up, touched this trend line, and then collapsed off it. And as you can see, this looks like the third rally is finished now, and we're now entering a downward phase. So you need to study this chart very carefully. What is interesting is that the S&P didn't get up to this resistance level here at 4170, which it might have done, but it didn't do that. It came up to the trend line and then fell back. Also notice on this chart, we've got the 200-day simple moving average and the 65-day exponential moving average. And those two moving averages are used to determine the golden cross. As you can see, in terms of that, we broke down into a bear trend on the 7th of March. And as of yet, the 65-day is still nowhere near the 200-day. So despite the upward trend, the 65 remains below the 200. And now we're in a downward trend. So I expect that this 65-day moving average will cycle round and start sloping down again. And we are not yet at a golden cross buy signal. So I think that there is still some excessive bullishness in this market, which I've spoken to you before about, and we've talked about it in the previous confidential report. But now I think the bears have got dominance on Wall Street, and I think they will take this S&P 500 index down below this low over here, which was 3577. It'll probably take quite a few weeks, and we expect it sometime towards the maybe around the beginning of February or in the middle of February, that low point, that next low. That is roughly what the interval is telling us. The bear trend will probably last about 2 months, maybe a little longer. But there's no doubt that we're in a bear trend. We've got successive lower lows and lower highs. And the bears are rubbing their hands in anticipation of a strong downward trend now. All right, let's turn our attention now to Europe and to Ukraine particularly. Russia, of course, since I last spoke to you, has withdrawn from Kherson, which is a major victory for Zelensky. Putin has made no comment on this withdrawal whatsoever. He seems to be intent on blaming one of his various generals. And of course, there's intensified fighting in Donetsk. And I think that's because Putin is absolutely desperate now for some kind of win. He needs some kind of win. Just like Trump, he, of course, is being painted as a loser. He is also a wannabe tyrant Well, he is actually a tyrant, far more so than Donald Trump ever really was. But he is being painted as a serial loser, and he's facing one humiliating loss in this Ukraine war after another. The Russian propaganda machine is really battling to talk about strategic withdrawals, when in fact what has happened is that they've had the hell beaten out of them. Inevitably, Ukraine will cross the Dnipro River and push the Russians back further. Crimea is now clearly in danger. Ukraine has got no intention of stopping fighting during winter, and Russia's 300,000 call-up is resulting in huge casualties of ill-equipped, ill-trained novices in the field. And they, of course, are up against a vastly experienced Ukrainian army, which is now being well supplied by NATO. There are three important points that I think you need to think about here. The first one is Chechnya. Tens of thousands of Chechens are now fighting for Ukraine, and an insurrection in Russia is now a possibility. In other words, Chechnya could rise up against Russia, opening a new war front for them to put down. The second point that I think is important is that Putin's health problems have come to a bit of a head. The other day, on camera, he fell down some steps and he soiled himself in public. Again, this is a further humiliation. Indicates that he probably does have colon cancer and therefore battles to control his bowels. So that is a big problem for him as well. Joe Biden, of course, has now offered to talk to Putin. And that's interesting. Why now? Why suddenly now? And I think it's because Biden senses that Putin is in a very weak position. And of course, that's always the best time to commence negotiations, when your opponent is in a very weak position. If Biden can bring the conflict in Ukraine to a halt, it will be a major political win for him. Major. But of course, don't forget, it will not end the bear trend in American shares. The S&P 500 is in a bear trend, and it will continue to be in a bear trend. What happens in the Ukraine war should not have a great impact on that. Okay, let's look now at the situation in South Africa. Of course, the big news here is the Phala scandal, which has obviously impacted on President Ramaphosa, bringing him quite close to resigning the other day. But Ramaphosa, I think, has got some quite committed support both within the ANC and outside it. In the recent nominations, he got over 2,000 nominations from the ANC's 3,500 branches. His closest rival, Zweli Mkhize, got only just over 900. The NEC has now also rejected the parliamentary panel's report on Phala, and they've sided with Ramaphosa. Investors in this country have heaved a sigh of relief. The impact on the markets was dramatic. The rand fell 4% and then strengthened. The 10-year government bond fell to a yield of 11.7% temporarily. But Ramaphosa remains this country's and the ANC's best option. And I think that he will get past this problem. And even though he came close to the edge of the cliff, he was persuaded to remain. And I think all of us that live here can be very grateful for that, whether we are supporters of the ANC or not. So he will survive the ANC's elective conference in our view. That's always been our view. But the big problem lies ahead in 2 years' time, when the ANC must fight a general election. Current polls indicate that they will only get 41% of the vote, and we think that in 2 years' time it may even be lower than that. Which means, of course, that they will have to make a compromise. In our view, that compromise will almost certainly be with the DA, firstly because they're the largest opposition party, and secondly because their policies are not that different from those of the Ramaphosa administration. In his closing speech to the NEC, Ramaphosa talked of the triple problems in South Africa, being poverty, unemployment, and inequality. We, however, suggest that the true problems are productivity, corruption, and state indebtedness. Of course, if Ramaphosa had resigned, then David Mabuza, the deputy president, would have become president. And he has a massive scandal hanging over his head, the land scam from 2002. A new case has been brought by Outer and handed to the National Prosecuting Authority with all the evidence in that case. But so far, 6 criminal cases on the land scam have been quashed in the past. Mabuza, of course, claims that he is completely innocent. Let us turn our attention now to the economy. GDP growth in the third quarter was a surprising 1.6%. This is a big surprise. Everybody thought that with load shedding and the other problems in this country, rising interest rates, the growth in this third quarter would be bad. In fact, economists were predicting about 0.6%, so they were way out here. It was up 1.6%. Of course, don't forget the second quarter GDP actually shrank by 0.7%. Some of that was due to the flooding in Natal. But clearly, the economy is still being boosted by higher commodity prices, and there seems to have been some exceptional government consumption during the third quarter as well. Inflation, of course, was 7.6% in October, above economists' predictions, and that has resulted in a further 75 basis point hike in interest rates. World inflation, of course, is very high. The UK is at 11%, Europe is at 10.5%, and the US is at 7.7%. The Reserve Bank has had to keep pace in order to make our government bonds attractive to overseas investors. Core inflation, which of course excludes food and energy, was 5% and rose 0.3% in October month. Governor Kanyago, that's the governor of the Reserve Bank, says that the repo rate at 7% now is still accommodative. In other words, it's still stimulating. In our view, the Reserve Bank has managed monetary policy very well in this country. It acted decisively and early last year to stay well ahead of the trend in international interest rates. Private credit extension in September was 9.7%, above expectations, the average expectation of economists, which was 8.15%. Consumers are clearly spending on credit, partly to cope with rising fuel and food prices, and credit card debt was up 20.5%. Overdrafts rose by 13.1%. Consumers are using their credit cards for groceries. Household debt is about 2/3 of income, and that is down from the peak during COVID-19, but moving up again. The Debt Busters Index says that unsecured debt is up 25%. People with an income of over 20,000 Rand a month have a debt which is 1.5 times their income. I'm talking there about their annual income. Of course, we've got rising fuel, food prices, and interest rates, which is moving a lot of consumers towards some sort of debt trap. Unemployment, however, dropped by a surprising 1% in the third quarter, down to 32.9 from 33.9 in the second quarter. Stats SA says that the country has added 1.5 million jobs in the third quarter, 80% of those coming in the formal sector. Most of the jobs were created in manufacturing, construction, transport, and trade. The financial sector, mining, and agriculture were down. We are, of course, a little skeptical of this unemployment figure and waiting for some kind of confirmation. Unemployment figures in this country are always a little suspect in our view. The trade account shows a surplus of 175.5 billion so far this year, and that compares with last year's 347 billion at the same time. So that is due entirely or largely to a drop-off in commodity sales. But South Africa is still running at a profit, exporting more than it imports, and the surplus is falling. Imports, of course, were subdued by load shedding. Load shedding has a negative impact on imports. Motor vehicle sales in October rose by 11.4%. New car sales were 10.4% and exports were up by 14.5%. These numbers defy recessionary conditions. Usually car sales are down in a recession, but somebody is buying. Tractor sales also hit a 40-year high in October, 50% above last year. Of course, that's got a lot to do with the good rainy season that we have been experiencing. And grain prices, of course, are exceptionally high because of the war in Ukraine, which has made a worldwide shortage of grain. Mining production was down 4.5% in September, and that's the 8th month that mining production has fallen in a row. Iron ore production was down 23% and down 15% in August. So that side of things not going so well. ABSA says that commodity prices fell by 4.6% in the last 5 weeks from the same period last year, and commodity prices generally are down 13.8% from the September quarter of last year. Manufacturing was up 2.9%. Third month up in a row despite load shedding. It's impressive. The Organization for Economic Development worldwide says that the world economy will grow by 2%. So that's the OECD in 2023. So they're looking for 2% growth in 2023 with inflation rising to over 9%. South Africa is expected to grow by 1.1% according to them in 2023 with inflation declining. Black Friday sales were better than last year, but mainly focused on consumables. So not so much big ticket items, but more on consumables. There was a huge swing towards online buying, and I think that's mainly because consumers wanted to avoid queues and crowded shops. But it was interesting that Black Friday sales were up. Of course, the government has unilaterally implemented their 3% wage hike for civil servants, and the unions, of course, are not happy about that. They've done 2 one-day strikes, which have both been pretty ineffective. I doubt if you even noticed that they were doing a strike. And the Minister of Finance, Mr. Godongwana, has just refused to bow to pressure. And this, to me, looks like a clear victory for the Treasury over the unions. Okay, let's talk about the Rand now. I just want to change the chart here and go and have a look at the Rand. Right. So there's the chart. I just want to go to 2 years here. Okay, you can see that the Rand has been climbing well, it's been falling against the US dollar. When this chart goes up, it's falling against the US dollar. But the recent rally on Wall Street is reflected in the Rand as this move from up there down to here. And you can see that it's now coming to an end, just as the rally on Wall Street is coming to an end, and we're now heading into a period when the Rand will probably be a bit weaker. So that's something to pay attention to. Of course, the big picture is that Wall Street is in a bear trend and the Rand is weakening. So that's the big picture between these 2 channel lines that I've drawn in here on the chart. We expect the S&P 500 will now fall through its low at 3577, which it made on the 12th of October 2022, and will go to a new record or new cycle low. It did reach 4076 on the 1st of December, and that was in line with the trend line that I showed you earlier. On the 12th of October 2022, the Rand was 1830. So that was up here, over here, see, 1830 to the US dollar. During this rally, it strengthened all the way back to 17 Rand to the US dollar. But we think a new pattern of weakness is going to start now. The strength on the S&P has rallied, but now we've got weakness on the S&P, and we can expect the Rand to weaken in tandem. Okay, probably by the beginning of February, we can look for a Rand around 1950 to the US dollar. That would be our expectation. Old Mutual is predicting that the Rand will strengthen next year. I'm just giving you an alternative point of view. Now they say that the rand by the end of next year will be at 15 Rand 20 to the US dollar. And they base that on two assumptions. First of all, that the Federal Reserve Bank in America will pivot and start, first of all, stop raising rates and then start to reduce them. And secondly, their second assumption is that the debt level in South Africa will come down, the government debt. We think that their assumption about government debt is probably reasonably accurate, but that their assumption about the Fed's pivot is probably wrong, maybe premature. We think that the bear trend in America will continue through the whole of 2023 and possibly longer. The sharp drop in the rand over Ramaphosa's threatened resignation shows how politically sensitive this country still is. We have recovered, the rand has recovered, but not all the way back to where it was. And that shows South Africa's political vulnerability. All right, let's just talk a little bit about Eskom. In our view, Eskom is becoming increasingly untenable. The energy availability factor should be around 75% or more. It's currently around 58%, and of course, that means we have more or less constant load shedding. And of course, Eskom's persistent debt problems continue to be an issue. Load shedding is dragging the GDP growth down in this country, and Eskom has lost about half a dozen of its most senior and experienced staff recently. Many have left because of enormous job pressure, and some have left because they were threatened by the entrenched criminal syndicates which seem to dominate Eskom. De Ruyter, the CEO, says that these criminal elements account for at least 2 levels of load shedding. So that's interesting. When we have level 4, we should be at level 2. When we have level 2, we should be out of load shedding completely. And the police are doing very little. Only Eskom's security is opposing them. So far this year, we've had 170 days of load shedding, and Eskom has run out of money for diesel to run its open cycle turbines. They managed to get 50 million litres of diesel from Petro SA, which tided them over for 2 weeks, and now they've had to go back to the Treasury to get more money to buy more diesel. Of course, all this load shedding is taking its toll on smaller companies. In September 2022, liquidations were up by 11.8%. Even Transnet is asking for proposals from the private sector to supply renewable energy. They're clearly finding Eskom too expensive and too unreliable. But South Africa is building about 1 gigawatt of renewable power installations every year now. Renewables are now about 10% of South Africa's total power. And Eskom is beginning to decommission old coal-fired power stations. The Just Energy Transition Plan is now finalized. They're talking about it requiring 1.5 trillion rand to implement, of which, of course, as you know, we already have $8.5 billion, which was agreed by a variety of European countries, and the World Bank has put up another 500 million. Obviously, this plan has got a long way to go, but South Africa is switching to renewables inevitably. It has to, basically. And you do well to take that into account in whatever analysis you do of the markets. Okay, let's look at some companies. There's a new listing coming to the market this month on the 13th of December. Zeda, which is a car rental and fleet management company which is spun out of Barlow World, will come to the market. They have 57,000 vehicles. They operate in 10 African countries. They have 14 motorcar dealerships and a turnover of about 8.1 billion. With a margin of, they say, 15.5%. Clearly, this is a well-established and highly profitable business, and certainly it's worth watching that listing and making some analysis of it. Glencore, okay, this is obviously a huge international commodity trading firm. It's one of our favorite shares at the moment. Its financials for the 6 months to the 30th of June, it said, global macroeconomic and geopolitical events during the half created extraordinary energy market dislocation, volatility, risk, and supply disruption, resulting in record pricing for many coal and gas benchmarks. Now, as you know, Glencore does produce quite a bit of coal. And then in its update on the third quarter, it drew attention to a range of events, including extreme weather in Australia, industrial action at nickel assets in Canada and Norway, which has since been resolved, and the emergence of a significant supply chain issue in Kazakhstan stemming directly from the Russia-Ukraine war. We advise that you should buy this share, and let's just put a bit more data on the screen. When it broke up through its downward trend line, its long-term downward trend line, that break came, as you can see here on the chart, on the 2nd of December, when the price was 45 Rand 30, sorry, 45 Rand 30. It's now up here at 111 Rand 86, so it's gained 161% over this 2-year period. All right, the next share I want to talk about is Capco. Capco, of course, owns Covent Gardens in London. So just put a bit more data on the screen here, a little bit more even than that. As you can see, it was in a downward trend. It rallied, broke up, but moved sideways, and now it's moved down again. However, at this stage, Capco is trading at less than half of its net asset value. In its financials for the 6 months to the 30th of June, it talked about strong operational progress at Covent Gardens and also high occupancy levels and excellent demand. It looks like this Rand Hedge share may be turning, and certainly it is very cheap. It made a bottom over here at 1933 cents on the 12th of October and now seems to be trending up. Okay, the next company I want to look at is Argent. Argent manufactures and beneficiates steel and aluminium. So it's a small company, not a big company, but quite an interesting one. And as you can see, it's in quite a strong upward trend there. In its results for the 6 months to the 30th of September 2022, turnover was up 13.5% and headline earnings per share were up 22.4%. Despite this strong upward trend, which you see here on your screen, this share is still trading on a PE of around 4. It's around 4.03, just over its previous levels. And this company is trading at 60% of its net asset value. So with a PE like that and trading on 60% of its net asset value, it looks like very good value to us. Okay, Southern Sun Hotels, which was of course spun out of Tsogo and separately listed. We've been saying for some time that this share is a good buy. And you can see it broke up through its long-term trend line. Let's put a bit more data on the screen. There's the downward trend line. We had an upside break over here on the 22nd of February 2021 at 178 cents. It's now talking in its latest results and the results for the 6 months to the 30th of September 2022. We're talking about an occupancy level of 46%, and the company is profitable. We expect occupancies to rise to about 60%. So, this share, which has already moved up from the break here where it was at 178 and it's now trading at about 416 cents. So we think it's got further upside potential from where it is now. Okay, let's look at Old Mutual. We don't often look at Old Mutual after the unbundling of Quilter and Brightsphere and most of Nedbank. This share has been in a downtrend for a long time. Let's put 2 years on there. You can see there's the downtrend. Here's an upside break, or what looks like the beginnings of an upside break taking place. In its results for the 9 months to the 30th of September, APE sales were up 17%. Gross written premiums rose by 12%. On a PE of 4.7%, 4.74%, on a PE of 4.74 and a dividend yield of 5.86%, we regard this share as very cheap. We think it's on the brink of an upside break through its trend line. Okay, then Omnia, the fertilizer company. We've obviously talked about this company before. They do chemicals, fertilizers, and explosives. They're linked, of course, to the agriculture industry and to mining. In their results for the 6 months to the 30th of September, revenue was up 19%. And headline earnings per share rose by 32%. During the downtrend, we suggested that you apply a 200-day moving average, and there it is. You can see the 200-day. There was an upside break here on the 10th of September 2020 at 27.47, and it has subsequently moved up. It's now trading for around 67.49, so it's gone up very strongly. But the price earnings ratio is still only 10.6, so it still looks like good value to us. Final share that I want to talk about today is Lewis. Lewis, of course, remains one of our favorite shares. It's one of the best shares on the JSE for private investors. In the results for the 6 months to the 30th of September, revenue was up 4%, but headline earnings per share was up 19.2%. So it's still got a virtually ungeared balance sheet and is trading on a price earnings ratio of 5.43 and a dividend yield of 6.74%. So we regard this share as extremely undervalued. It's a very good company, almost ungeared. We started recommending it when it was 29 Rand, and last night it closed at 49 Rand 50, as you can see from the chart here. So we still think this is good value. Bear in mind, of course, folks, that we still are in a bear trend on Wall Street, and so that will impact on our market. You need to take that into account in any decisions you make to buy shares on the JSE. The other thing to remember is that this is the last webinar of its type for this year and the last confidential report. And we will talk to you again on the 1st of February next year, which is the first Wednesday in February next year, when we will do another confidential report for the 2 months. There's no confidential report in January, all right, that we take a month off there. So I take this opportunity to wish you and your family all the best for the festive season, and I'll talk to you again next year. Thank you for listening to me.